Hey everyone, I'm Sean with The Modest Wallet, and today we are talking about how to invest in stocks. If you've been thinking about investing but just don't know where to start, then this is the video for you.
This is for you.
A lot of people think you need to have a ton of money to start or know a lot about investing in stocks, but I'm here to tell you that it can be quite simple.
It's quite simple, really.
It's actually crazy because you can start investing with something as simple as your phone. We will look at 5 easy steps for how to start investing, as well as the benefits and the downsides of investing. So stay tuned for more. I'm glad you're here. If you're new to the channel, then don't forget to subscribe. It's free and it makes sure that you know every time we release a new video. And if you're already a subscriber, we're also glad you're here and thank you for that support. It definitely does help out the channel.
David, we are happy to support this modest little vigil you're hosting.
Before I dive deeper into how to invest in stocks, I'll leave a link above so that you can also check out our How to Start Investing for Beginners video. That'll lay the groundwork for you if you are completely new to investing before you start how to invest in stocks. Enough of that, let's get into how to invest in stocks. The first step as a beginning investor in stocks is your investing approach. That's whether it's going to be a more active approach or a passive approach. When you opt for a more active approach, you will be 100% responsible for which stocks you're investing in. In other words, you'll be creating a portfolio that is essentially based on your fundamental research. For example, you might have a passion for growth stocks and you might choose stocks like Tesla, Facebook, or Square. Or you might decide to play it a bit safe and go with companies that are blue chip stocks, maybe something like Johnson & Johnson or Home Depot. Either way, you won't have any assistance when it comes to stock selection process, and you will need to actively rebalance and manage your portfolio. Then there's the more passive approach to stock market investing, and you might want to consider a fund. For example, you might choose to invest in an ETF that tracks a stock market index fund like the Dow Jones or the S&P 500. Or you might even consider a mutual fund that will look to actively outperform the stock market. These passive investment options require virtually no input from you, so they suit both the inexperienced and the time-starved investors. So let's summarize step 1. Active investors require a more hands-on approach, whereas passive investing requires less buying and selling of securities. And because of this often is why investors choose mutual funds or ETFs for their investing. It is also worth noting that historically, passive investments have outperformed actively managed investments. Step 2 is deciding how you want to invest. Once you've established whether you are more suited for active or passive investing, or perhaps even a combination of the two, you need to then think about the best way to achieve this goal. In many cases, investors will take a DIY approach. This means that all investments are self-directed through a single brokerage. If you want to invest in Apple stocks, you would simply log into your brokerage account, search for Apple, decide how many shares to buy, and complete the purchase. Then when it came to selling your Apple shares, you would once again do this on a DIY basis through your brokerage platform. Alternatively, you might consider a more hands-off approach in the form of a robo-advisor. For those of you who might be unaware, robo-advisors give you access to a pre-built portfolio based on your financial goals, risk tolerance, and time horizon. The risk-reward trade-off is typically established when you sign up with the respective platform and answer a series of questions. Robo-advisors will also take control of portfolio rebalancing, meaning that the platform will automatically add, remove, or rewrite your portfolio of stocks. And that would be based on the current market conditions. This ultimately ensures that your portfolio aligns with your investment goals. That leads us to our third step, which is opening up an investment account. So far, this video on how to invest in stocks has covered the importance of choosing an investment approach through an active or passive strategy. It has also provided a guide for whether you are best suited for self-directed purchases or robo-service advisors. And this is the part where you need to think about opening an investing account with an online broker. And this process has been simplified in recent years with ever-growing interest from the retail investor sector. With that said, there are a ton of online brokers serving US investors, so there's lots to think about before selecting a provider. Here are the most important metrics to consider. You want to make sure that safety is provided, so making sure the broker is regulated with the SEC and FINRA. You want to make sure that there's supported markets. Does the broker support your preferred market? Most platforms cover thousands of stocks across the New York Stock Exchange and NASDAQ, but if you want access to international equities, make sure the broker offers this. Next are commissions. How much does the broker charge in trading commissions? Many online brokers now allow you to invest in US listed stocks and ETFs on a commission-free basis. And finally, you want to look at the ease of use. You are assuming that you are relatively new to the world of online investing, so making sure the broker offers a user-friendly experience is incredibly important. Now, if you're choosing to invest in stocks with an active DIY approach, you should seriously consider opting for a broker that offers retirement accounts. This will allow you to invest in stocks in a tax-efficient manner. The main retirement accounts available to US traders include Roth IRAs and traditional IRAs. If you believe that upon reaching the age of retirement, you will be on a higher tax rate than a Roth IRA could be for you, this will ensure that the stock investing contributions can grow without paying any tax. Instead, you'll make after-tax contributions. In a similar nature to a Roth IRA, a traditional IRA allows you to invest in the stock markets in a tax-efficient way. The difference is that you will make pre-tax contributions, which is best suited for those that expect to retire on the same or lower tax rate. In addition to a Roth or traditional IRA, you should also consider setting up a 401k plan through your employer. 401k also allows you to segment part of your salary into the stock market in a tax-efficient manner. Ultimately, it's wise to maximize your chosen retirement account to ensure you minimize the amount of tax that your stock investments attract. Summarizing step 3, choosing the right brokerage and account type requires some research and due diligence to get the best out of your investments. Make sure you shop around before selecting a broker for your investments. That leads us to step 4, which is to decide how much you should invest. Before you start investing in stocks, it is definitely a good idea to take a step back and assess your budget. Not only should you look at the disposable income that you're going to have at the end of each month, but also which debt obligations you have. For example, if you already have large amounts of credit card debt, you are best advised to focus on reducing this first. After all, it's all good and well to target stock market gains of 10% per year, but if you're paying more than 20% per year in credit card interest, this is counterproductive. Additionally, you should also assess your investment budget, keeping in mind your financial goals. For example, if you're looking to reach a short-term target, consider how much you need to inject into the stock market and for how long. Or if you're looking to create a long-term investment plan through a retirement account, consider how much you need to maximize your contributions. Ultimately, the most important thing to consider is that you never invest more than you can afford to lose. This means that under no circumstance should you attempt to borrow capital in order to fund your stock investment strategy. Step 5 is to begin investing in stocks. At this point in our video, you should have all the information you need to get the ball rolling. Now it's time to start adding some stocks into your investment portfolio. But before you do, there are a few considerations that are important to make to ensure you invest in the most effective and risk-averse way possible. Diversification. You will hear a lot about diversification as you begin to invest in stocks. This is for good reasons, as seasoned investors will always ensure that they have a diversified portfolio to mitigate their risk exposure. A well-diversified portfolio might contain stocks that operate in sectors such as tech, retail, pharmaceuticals, banking, and oil. And each sector would then contain a different type of stock to balance out the risk. This might include a combination of growth, blue chip, and dividend stocks. Ultimately, the key benefit to diversifying your stock portfolio is that you will not be exposed to a single market. For example, if you were heavily invested in tech stocks and the sector takes a turn for the worst, your entire portfolio will be dragged down. However, if you were invested in other sectors, you wouldn't feel the impact anywhere near as much. On the contrary, it is hoped that your other investments counter the losses from your underperforming stocks. Stick with what you know. As an inexperienced investor, you might be tempted to chase that big win. By this, we mean investing in stocks that you quite don't understand. People do this because they have a hunch that they could outperform the wider markets. However, if you don't have the required knowledge to perform in-depth research on the stock in question, it's best to leave it alone. Instead, you will find much better success investing in companies that you know know and understand. Think along the lines of Microsoft, McDonald's, Disney, Johnson & Johnson, and JP Morgan. These companies have gone through several stock market recessions and have always recovered. Avoid volatile stocks. Unless you are an experienced investor that can actively research and analyze the markets, it's best to avoid volatile stocks. Instead, opt for equities that historically grow slowly and steadily. This is largely because newbie investors often find it difficult to deal with the emotional side of investing. For example, if you're holding a growth stock like Tesla, it is not uncommon for the shares to rise or fall by more than 5% in a single trading day. This is great when things are going your way, but if you can't deal with the short-term impact of seeing your portfolio drop by above average levels, blue chip stocks are the way to go. As we noted earlier, these are the stocks that have a long-standing track record and have dominated their sectors for many, many years. Sure, the growth rate is going to be a lot more modest, but stock investments should always be viewed as a long-term strategy as well. With this in mind, you should avoid penny stocks at all costs. One thing to note is that it is best to start off with an index fund like the S&P 500 instead of trying to pick stocks. This will give you access to 500 large US companies at various weights, so you are instantly creating a diversified portfolio. Plus, the S&P 500 is regularly rebalanced, so you can sit back and allow your money to work for you. If you're still on the fence as to whether the stock market is right for you, let's talk about the main benefits of investing in stocks. First, there's the growth potential, which US banks are still paying a small fraction of 1% in interest to savers, which is significantly below the rate of inflation. So by investing in stocks, you have the potential to see your wealth grow at a much faster pace. This can be seen more clearly since the S&P 500 was launched in 1926. It has generated an average annual gain of more than 10%. The next benefit is the low barrier to entry. Investing in stock markets for the very first time has never been easier. So now all you have to do is open a brokerage account, make a deposit, and choose which stocks interest you. As such, the process can be completed at home with ease. Another benefit are the 0% commissions. Most leading US brokerages sites now allow you to buy US listed stocks without needing to pay any commission. Another benefit are fractional stocks. A number of leading trading platforms offer fractional stocks, meaning that you can buy a small portion of a single share. And this is really great in terms of diversification and modest budgets, especially when you look at how much stocks like Amazon and Tesla are trading at. Another benefit is liquidity. When you buy stocks listed on the New York Stock Exchange or the NASDAQ, your money is never tied up. This is because these two exchanges benefit from large trading volumes, so you can get cash out for your stocks at any time during the standard market hours. The last benefit that we'll mention is diversification. With tens of thousands of stocks to choose from, never before has it been easier to create a highly diversified portfolio. This is especially the case when using a broker that supports fractional shares. As always, there are always some downsides of investing in stocks that you need to consider before risking your capital. First is the risk of loss. There is no guarantee that you will make money when investing in the stock market, especially if you are choosing individual equities over an index fund like the S&P 500. There are countless examples of stocks that are no longer here to tell their story. In many cases, there are stocks that are now worth just a fraction of their former glory, so always consider the risks. The next downside are emotions. One of the biggest barriers that inexperienced traders find when investing in stocks is the emotional side of things. Like all asset classes, the value of stocks will go up and down throughout the day. When your chosen stocks are going through a prolonged downward trend, this can be difficult to handle. And another downside to investing in stocks is time. If you're looking to actively pick and choose stocks on a DIY basis, then you need to be prepared to invest more than just money. That is to say, you will need to also invest your time to research and analyze the markets on a regular basis, and the best way to counter this time requirement is to opt for a diversified index fund like the S&P 500. There you have it. There's a summary of our 5 steps for how to invest in stocks. We also looked at the benefits and some of the pitfalls or things that maybe don't always work out when you're investing in stocks. If you found value in this video, then definitely go ahead and smash that like button. That really helps the channel out. I'd also love to know which stocks you are buying, so comment below your favorite stocks, and I'll see you in the next video.